What should we expect is, look, I'm pretty cynical. I don't expect much out of Washington these days, but there are a lot of hardworking people at the SEC who really want to get this right, and they've been put into an almost impossible situation. On the one hand, there is a lack in the crypto markets of basic principles that we know helps ensure markets to work better. Things like best execution, surveillance of manipulation, disclosure and management of conflicts of interest. So if you think about it, those same things are keeping institutions away. So the crypto industry needs to embrace those, and we'll go backwards, right? If you're an institution, the last thing you want to hear is that there are side deals between this exchange or this broker and these people, which give them a better knowledge of what's going on in the market. Either they have better access to data, or they have better access to the market, etc. There's no platform to be certain what kind of deals are going on. So fair markets is a big deal. Orderly markets is another big deal. Flash crashes, that really bothers institutions. And so protocols being established at exchanges on a consistent basis to stop flash events, those are things that matter. Should the regulators be enforcing that? Well, they'd like to, but the question is how prescriptive can they be? So that sort of principle being enforced would be a good thing. Conflicts of interest, those are rife in the industry. There are firms out there that run retail brokers, exchanges, fund processes. Well, if you're a retail firm, you generally have an obligation to try to seek the best price for your customer. Well, what if your exchange isn't the best price? Do you disclose that you don't go to other exchanges, that you only go to your own exchange? If it's disclosed and people understand that, that's one thing, but that's not even disclosed. So managing conflicts of interest is kind of a big deal. In the equity world, that would never be allowed. When you talk about best execution, it's more basic than that. If you're a broker and you do an OTC trade and you do it at 9,000 Bitcoin for somebody, and it turns out that at that time they could have sold it for 9,500, or they could have bought it for 8,500, depending on what the market's doing. That's a bit of a problem if the people actually don't know that those prices existed. So at least having some knowledge is there. And once again, that's something that people can do something about. We at CoinRoutes have invented a benchmark called real price, which at any instant in time uses the consolidated order book to say, this is what it costs to buy 5 Bitcoin, this is what it costs to sell 5 Bitcoin, and several other quantity amounts. So there's a lot of things that can happen. The question you ask is, what should regulators do? And I think they're in a rock and a hard place. They want these sorts of principles to happen, but let's say for the sake of argument, they called Ethereum a security. Well, if they did, the SEC, then immediately all the current exchanges that trade Ethereum would have to shut down, because none of them are broker-dealers and none of them are ATSs. And the SEC does not want to cause that kind of disruption. But if they don't say anything about it, then how do they get these sorts of principles to come in? So my answer, and I just wrote an article about this, which I called It's a Bird, It's a Plane, No, It's Bitcoin, is to say that, well, what they should do is they should give no action relief and let ATSs or broker-dealers actually trade these products without penalty. Not saying they should avoid the best principles of just and equitable trade, fair and orderly markets, etc., but let them trade those, because they will immediately out of the box come with a lot of that, and then give a time period for the existing exchanges and brokers to become registered entities, but still not enforce the whole rule book, because the whole rule book doesn't work. Because there's one important point here, and that is that crypto assets are polymorphic. That's the word that I like to use for it. Polymorphic means that depending on what you're using them for, they actually are different things. So when you're buying or selling Bitcoin or Ethereum on an exchange, you're normally doing it as an investment. We would traditionally think of that as a security. It's fungible, you could buy it here, you could sell it here, etc. It's for an expectation of a profit, etc. But when you're using it within a network, like using Ethereum within its network to build an ERC20 token, it's really a commodity. And when you're using it outside of its own network, it's really a currency, because you're using it to pay for something else. So an ICO, someone who does an ICO and gets paid in Ethereum, they're taking that on as a currency. So it's literally 3 different things depending on the use case. So polymorphic. Here's the problem. Securities regulations, commodities regulations, and derivatives regulations associated with it, and banking regulations associated with currencies often conflict and overlap. If you sit with a bunch of lawyers for all 3 and try to figure out how anybody can satisfy all 3 for the same product, then you're going to deserve a Rhodes Scholarship, because I'm pretty sure there is no way for that to happen, which would mean if we enforced them all, that we would drive the industry completely outside of the United States, because our regulations overlap. So there's a big problem here. It needs a new approach. That's why a principles-based approach is the only way I can see